Good morning, all, and thank you for taking the time to join us for today's investment webinar. My name is Stuart Murray, and I look after WA as an investment specialist for Morningstar. So I'll be your MC today, and we look forward to an engaging session with you. Okay, so today's session is with the FAAA for CPD accreditation. So you'll receive an email from us in the next week or so with that confirmation, so don't worry about that. A recording of today's presentation will also follow with a copy of today's content. And of course, all importantly, we do value your feedback. So please take the time, if you will, to complete a short survey at the end of today's update. We always value constructive feedback. If you click to the next slide, please, just in terms of the logistics for today, if you've got any questions, use the Q&A option for any questions as highlighted on the slide at the bottom of your screens. We'll do our best to work through those questions live as time permits. Worst case scenario, if we can't get to them live, we'll definitely come back to you after today's call. And then just onto our usual disclaimer on the next slide. Just to highlight that today's presentation is general in nature and not to be seen as active advice. We leave that privilege and responsibility to you as trusted advisors who have a deep understanding of your clients' individual needs. As such, we have not considered any person's objectives, financial situation, or particular needs in today's presentation. Please refer to our financial services guide for more information if needed, which is available on our public domain at morningstarinvestments.com.au. And that then leads us into today's presentation, which has been titled Navigating Market Volatility by Staying Disciplined. Truly appropriate given what we've gone through so far this year. For those of you just quickly who aren't familiar with our client-centric approach, we partner with advisors and advice groups across three main pillars, namely practice optimization, behavioral coaching, and investment solutions. This integrated partnership, we feel, aligns client, advisor, and practice goals to achieve a personalized, differentiated value proposition to grow a modern advice practice. And of course, all importantly, to serve the end client better. So today we're going to focus in on that investment pillar as Bianca Rose, a senior portfolio manager and integral member of the investment team, walks us through the ingredients of successful portfolio management in what has proven to be a bumpy ride thus far in 2026. Bianca, we look forward to the insights.
Thanks, Stuart. So as Stuart talked about, today we're going to be talking about navigating market volatility by staying disciplined. And in terms of our agenda today, so first of all, we're going to start with an economic update, looking at the key indicators in the US and Australia and how the Iran war in particular has impacted some of those. Next, we're then going to provide a recap of how markets have performed to date, looking at this calendar year and also this financial year to date. And then finally, we're going to discuss our portfolio positioning amidst this environment. So first up, just starting up with an economic update and the Iran war impact. So if we have a look at the world today, we continue to live in a very uncertain geopolitical environment. And I think that has been a feature for the last few years. And if we have a think back to 2022, we started with the conflict in the Ukraine and Russia, and it is still ongoing. And obviously that has caused tensions between Europe and the US in terms of being traditional allies, of who takes the lead in terms of providing support there. And then a further point of contention between Europe and the US has been Greenland, where the US has announced that they'd like to take over Greenland, much to Europe's chagrin. And that is due to Greenland's strategic defense positioning plus their rare earth materials resources there. And then if we look at this year in particular, we've had a very busy start to the year. So back in early January, we had the US come in to Venezuela, capture their president, and then announce that they will manage the Venezuelan oil industry going forward. And then at the end of February, we had another instigation from the US where they kickstarted the Iran war. And that's obviously been a feature of markets and a lot of market headlines alongside tech these days in terms of when will this end, when will this be resolved, and obviously resulting in higher oil prices. And so through that all, as we've kind of circled in the middle here, we can see a shift in country alliances and dynamics. And now if we just turn to the US, and when we have a look at the left-hand side here, what we've got is our economics team's GDP forecasts. And when we look at up to 2026, probably pretty average GDP kind of growth of around, just above 2%. But we are expecting in 2027 to see a dip, and we'll kind of talk through that a little bit more. And compared to January as well, we do see lower GDP growth expectations before kind of ramping back up in 2029 to 2030. Really on the back of lower interest rates, kind of hopefully spurring some investment, which we've seen dip more recently. And then looking at the right in terms of our economics team's forecast for inflation, really not much change from 2027 onwards, but obviously this year seeing quite a material change from 2.6 forecasted back in January to 3.3, really on the back of that Iran war and impact on oil prices. And maybe if we just have a look at that US GDP growth a little bit more in detail. And what I've got up here is looking at this from 2022 to 2025. We've got a number of different colours in there, but really, I guess if we look to focus on the 2025 to the right, the green colours there really highlight IT spending, and we've seen a lot about AI-related CapEx, and we really can see that coming through with that green bars, whether it be software research and development or it be data centres and IT equipment, kind of characterised by that lighter green bar. They're really ramping up, and we can see that coming through on obviously those big tech stocks, the hyperscalers really increasing their capex there. But on the other side, below the line, we're seeing quite negative capex happening in the rest of the economy, if you like. So when we're looking at real estate, whether we're looking at manufacturing, whether we're looking at residential spend, it is very weak versus maybe some other previous periods. We do see some weakness if you look to 2022 and 2023 in that residential capex expenditure, much weaker. And obviously that was off the back of higher interest rates coming through on that 2022 period, definitely affecting residential expenditure. But today, really, it's a tale of two cities between IT and non-IT in terms of expenditure. And then if we have a look a bit more widely at kind of, what has this looked like overall? As we know with the US is as primarily about a personal consumption GDP story, and that's indicated here through the blue bar, which is a very big constant, if you like, throughout it all. And then we have government spending, we have business fixed investment, which again has been really dominated by that IT expenditure and residential investment. But really, if we just go back to that blue bar of personal consumption, we can see kind of a valley kind of forming when we look out to 2026, 2027 and 2028 before kind of coming back up. And really, we're seeing weakness in that personal consumption kind of component there. Really, if we look at the last decade, personal consumption has been a key driver of US GDP growth, typically averaging around 2.7 to 2.9% growth. We are seeing that kind of dip in the next few years, more like 1.7 to 1.9, which is about a 1% drop, which is quite a bit. And obviously that reflects a number of things, which we'll go through in a moment, but basically the consumer is feeling a little bit less confident about spending within the US. And why is that the case? Well, there's a couple of things. When we look at tariffs, obviously tariffs have been a key feature of, Trump 2.0, and it was announced last year. And really what we've got up here in terms of our chart is in the terms of the bars is actual tariff rates, which have proven to be lower than the stated ones, which are in the dotted lines and the blue lines above. So that's just due to a number of exemptions and exclusions. But really, we can see that it has been a big ramp up in tariffs from 2024, where it was sitting around 2%. At the end of 2025, we saw tariffs hitting around 8%. And we do, though, expect those to moderate because, as you probably are aware, in the US courts, the validity of those tariffs have been called into questions. And as they kind of come come off, and also a number of exclusions are kind of put in place by the Trump government, given that this has been a very unpopular kind of introduction. We are expecting tariffs to come off. And so that's where we kind of maybe think that we will see some weakness in that spending in GDP for the next couple of years. But then as those tariff effects come off, we'll probably expect a more muted effect from tariffs. And then obviously the more recent development, which has also been affecting business spending and consumer spending, has obviously been the energy price shock from the Iran war. And when we have a look at the left-hand side here, what we're looking at is PCE inflation. So what's PCE? Well, it's personal consumption expenditure. So having a look at that, when we look at 2026, we are seeing the oil price shock and higher energy prices adding around 0.65% to inflation, and which is really causing that increase that I talked about at the outset of going from around that 2.6 level to, say, 3.3 in 2026. But it isn't as large as what we saw in 2022. A couple of reasons for that. I guess in terms of when we think about this oil price shock, it's not quite as high. So it's probably going to still lead to a very large, energy price increase of 22% in 2026. But that's versus almost 40% back in 2022. And plus, as we kind of continue, as economies around the world continue to transition to alternatives outside of oil for their electricity generation and the like, we are seeing kind of a lesser effect in terms of use. And we can clearly see that also on the right when we think about the 1970s, where what we show here is on the green kind of bar above the yellow bar is how much oil inputs into that inflation measure. And we can see in the 1970s, obviously that oil impact would have been a lot larger if it had happened today. And we can see that that green bar is a lot bigger than what it is today as we kind of gradually, I guess, as economies wean themselves off oil. And so then, what does that all mean for interest rate outlook in terms of the US? And when we kind of look at it from our economics team perspective, we are kind of seeing moderating and decrease in expectations. And so I guess there's two kind of things at play here. One, yes, we are seeing higher inflation from the tariff effects and also that oil price shock. But as I kind of noted at the outset, our economics team sees that for now, at least as just a next 12-month phenomena. Obviously, that is subject to how long the Iran war kind of takes. If it continues to be a feature, I think then those inflation effects will be kind of a bit more sticky. But at the moment, it's really more about that slowing spending coming from businesses outside of tech and also consumer spending, which I guess is kind of leading to that moderating economic growth, which our economics team thinks will have to spur on lower interest rates to spur that investment back on in a few years' time. And maybe then now turning our attention to the Australian market. And when we look at the Australian market, we've pretty much seen what we've got here on the left-hand side is annual real GDP growth. And then we've got the pre-20-year COVID average. And we can see that we're pretty much tracking near the average. We were a little bit below, but now we're tracking near there today. It's sitting at around 2.6% as at December 2025. And when we think about that, it's been fairly kind of unremarkable, not very, very strong considering where inflation is sitting at. So it's pretty, I guess, surprising in some ways why inflation has been so strong. But then if we look at the right, we can see that the job market here has been in pretty good health, and we can see unemployment levels really at the lows, although starting to ramp up a little bit. And we would have all seen the headlines about a number of AGI-related job cuts, and also we are seeing waning consumer confidence coming through. So it doesn't kind of maybe look as good on a future perspective. And then just maybe looking at where we're sitting in terms of inflation and interest rates here locally. So when we look at the left-hand chart, what we can see here is we've got the trimmed mean annual inflation. And as most central banks around the world, the RBA is probably not any different. They're looking to target a band of around 2 to 3% inflation. Now, we seem to be kind of consistently a little bit above that, sitting at sticky at around, the low threes. That's a little bit higher than what the RBA would like. And as you can see on the right-hand side, that has really kind of caused a ramp up in those interest rates coming out of COVID, as we saw a very big spike in inflation, and then kind of plateauing. And then we were leading into lower interest rates as those inflation rates were coming down on the left. But because it's proven to be a little bit sticky, it has kind of led to some recent interest rate increases. And if we now think about this recent oil price shock that's come from Iran war, we're now seeing, if you have a look at expectations versus 6 months ago versus 3 months ago, and now in the futures implied, which is the red line, it's kind of gradually keeps going up and up and up in terms of those rising interest rate expectations for here. So unfortunately, maybe no relief in sight. And on that point, I guess if we have a then think about the Australian consumer with the rising inflation levels and rising interest rates, it is leading to a drop in consumer confidence in terms of wanting to spend. And whether we look at it from the left-hand side, whether we look at consumer sentiment surveys or consumer confidence on the right, we're really seeing a sharp fall in how the consumer is doing. And as we know, probably coming out of COVID, we've all probably seen the Australian consumer did have a lot of savings into COVID. And I think that has been propping up consumer confidence as people has been eating into their savings. But now as those kind of savings are coming way down, the consumer confidence is kind of saying, oh, hang on a minute, I am getting into trouble here. And so we are seeing that real big fall. And so I guess that's what we have in common with the US there in terms of, waning consumer confidence there. And then now turning attention to markets and what has, markets done to date. And what we've got here is asset class returns for the calendar year to date to 17th of April. So I cut these a couple of weeks ago. Markets have since moved higher. But really here, what I wanted to illustrate is that if you look at this also leading to the financial year to date, so for those who are looking at their clients' balances as we head to 30 June, looking pretty positive, actually, particularly when you look at markets from a local return perspective. And what we've got here up the top is international equities, Australian dollar hedge returns, global infrastructure, global property. They're all, showing pretty strong returns here. When we look at it from an unhedged basis, that's where maybe we see a little bit of wobbles from a calendar year to date basis with a slight negative return just due to exchange rates, but nevertheless still pretty healthy when we look at financial year to date returns for international equities unhedged and also for Aussie equities. And really the kind of main segment that has been kind of quite negative over whether it be the calendar year to date or financial year to date has been the A-REIT sector. And again, that's probably not too surprising given those interest rate rises that I've been talking about in the Australian market. And then if we then maybe look at global equity sector calendar year to date returns, it's probably no surprise given the Iran war that the energy sector sits on the left here as the kind of highest performing sector. But probably what is surprising is that has been quite broad-based in terms of the positive return. So given all these headlines and the uncertainty around geopolitics and also with what's happening with the Iran war, you may think that equity markets might be reacting negatively, but as I've said, pretty much not the case outside of healthcare, where that has been impacted by obviously the regulatory policies being pursued by the US government. That's really been the only negative sector calendar year to date, and everything else is looking pretty hunky-dory at the moment. And of course, I think it's worthwhile touching on as well, though, global equities market concentration, though, remains a feature. And, really when we look at the index today, and what we've got up here is the top 10 index holdings as at March 2026, we can see that the top 10 names continue to be dominated by AI kind of related names and tech names and so on. Really, the only name is in the number 10 position at Berkshire Hathaway. And also it's kind of probably worth noting that that index concentration, if you add those numbers up, is sitting around 22% today versus if you looked at it a decade ago at March 2016, where we had it around 9% in terms of concentration. So a lot more concentrated today.
Bianca, just sorry to interject. We've got a question from the floor, came up for that slide. In terms of those sort of the largest 10 index holdings, which names do you hold overweight, and how do these fit in with your valuation-driven investment approach?
Yeah, sure. Thanks, Stuart. So for us, I guess one of the biggest kind of, key overweights for us is Alphabet. So, I guess for us, when we think about value, we don't think about value as just being low valuation metrics. For us, it's about intrinsic value. And is this, for us in particular with Alphabet, has very strong growth prospects and so on. And so we're looking for an undervaluation there. And as you're probably aware, Alphabet up until recently was seen as an AI loser. And so for us, when we think about probabilities, we felt like it was priced for a kind of very dire set of outcomes. And now that is changing as it's seen as more of an AI winner. And so probably you will see us trim a little bit there, but nevertheless, that is one name that we are overweight amongst those names. So we will hold some growth kind of stocks. We also own some stocks in Korea, for instance, as well in that tech space.
Great. Thank you.
No worries. And having a look at fixed income. And so while I showed pretty muted returns there, I think it's kind of worthwhile noting while we've seen equity returns being pretty strong, we're also seeing that happen in the credit markets here. And what I've got up here is on the top chart is you're looking at US investment grade bonds. And you can see here that the spreads that you're paying over government bond yields are kind of tightening again and are still pretty much at their lows, which again is pretty surprising given all the headlines we're hearing about geopolitics and also concerns about private credit. We're really not seeing that happening in the public fixed income markets. And likewise, when we look at the US high yield market, we're also seeing that, falling down and near going back to its lows as well. So again, markets seem to be pretty unconcerned at the moment, free from a credit perspective or equity perspective, about all the uncertainties and are kind of maybe pricing in more optimistic outcomes, we think. And so then turning to portfolio positioning. And what I've got here is on the red line is long-term market returns. Now, while I've spoken about all this, I guess, geopolitical tensions, all this uncertainty, probably again, if we look at the very long-term history and we've particularly just look at the last couple of decades, we've seen a number of events happen over this period. And I guess volatility is nothing new. And through it out at all, what we've got is what we kind of term as our vintages at the bottom, where we think of these as vintages because some of them, like a good bottle of wine, might take a year to kind of ripen. Some might take 10 years to ripen. And so what we like to do is have different opportunities come up. And we find that as these different market events come up, we see different dislocations occur and kind of make opportunities for us. So where are we seeing opportunities in the most kind of recent period? Well, as I mentioned, global healthcare has been a relative laggard for the last couple of years, obviously on the back of the Trump 2.0's presidency, where they've made a number of announcements in terms of adverse kind of regulatory policy. And I guess, there's been a lot of skepticism about vaccines and things like that, which has impacted the global healthcare sector negatively. And then also cost of living pressures, as I spoke about. What we're seeing is that's kind of coming through on a number of consumer cyclicals and defensive names. And we think it's been very uneven as well, because we've seen stocks that we have owned in financials, for instance, which are exposed to, I guess, moderating economic growth, doing very well. But we are seeing some of these consumer names getting hit by these kind of cost of living pressures, which again, we kind of think is kind of uneven. And so we've been seeing some relative value emerge in those two areas. And this chart here we've got is showing our valuation implied returns. So what we've got here is the blue bars show where we kind of see our valuation implied returns. So basically kind of the bars to the left, or the asset classes to the left, are the ones that we see as more attractive, and those on the right are the areas that we see less attractive. Now, obviously, I've got a select group of asset classes listed up here. We do cover hundreds of asset classes, but what I've just chosen to show is kind of some of our key positions where. And if you have a look at also the other two bars, what we've got here in terms of the orange and the pink bars is the changes in those VIRs versus 12 months ago and also versus 2 years ago. So maybe just to give an example, on the right, if you look third from the right, you can see European energy has quite got negative bars for orange and pink. That signifies that energy has done very well, and we're seeing very strong price movements, which means our VIRs have come down and that they were quite a bit higher come 12 months and 2 years ago. And then if we have a look at the left, where we kind of see positions today, one kind of segment is in emerging markets. We see a fair amount of value there, in particular within Brazil, and also China and Mexico. In particular, in terms of China, we do see some of the Chinese tech stocks there as being pretty nicely valued when you compare it to their US tech counterparts. But, probably not as attractive as it was 2 years ago, but they're nevertheless still fairly attractive, as indicated by that pink bar being kind of quite negative. And then the other opportunity, which I've alluded to, is stocks that or sectors that are kind of impacted by cost of living pressures. And so in that category, we can see European consumer discretionary stocks, consumer staple stocks, and also the healthcare stocks being negatively impacted by regulatory policies there. And then putting this all together, you might think, okay, after you've seen the left-hand side, we're going to hold only emerging market stocks, and we're only going to hold maybe segments that are impacted by, cost of living pressures. But no, really what we're looking for, as I've kind of alluded to with that vintage chart, is we are looking for different vintages to kind of work in different market conditions. While we're aware of the market environment, we're not looking to predict it. What we are just looking to do is say where the valuation might be reflecting an outcome and what we think probability-wise could happen on the other side. And if you just have a look on the left here, you'll see that international shares is a big part, just because we do have a lot of diversity within that area, whether it be by sector or region. And as you can see there, we have a fairly balanced view, whether it be by region in the middle, where we've got a fair amount in North America, Australasia, Europe, emerging markets in Asia. And likewise, we don't just have only consumer defensive, cyclical and healthcare stocks. We do find opportunities in the tech and communication services space, as we talked about earlier with Alphabet, and also real estate and some other segments.
Bianca, just before you move on, you may have touched on it with that explanation, but we did have a question around, I think on the previous slide, the USA came up sort of on the right of the slide as a less attractive sort of geography in terms of its valuation level. Yet on this slide, North America is quite a big allocation by the looks of it on that middle pie chart. Can you take us through the thinking there?
Yeah, sure. So I mean, in a lot of ways, that is related to us liking some of those cost of living pressure kind of related stocks, if you like, and also those healthcare stocks. So as I noted, really in terms of that regulatory environment. So for us, it's really about making sure that while we might not like the US as a whole, to be honest, it's really about the tech stocks. There is kind of a barbell happening within the US where a fair amount of those US tech names we do think are overvalued. And we did, if you maybe recall, maybe I'll just go back. We do have US tech on the far, US IT on the far right there as kind of one segment of why we don't like it as much. But we do see value in some areas like those consumer and healthcare kind of stocks.
Yeah. Fantastic. Thanks.
No worries, Stuart. So just having a look at this and putting this all together. So we feel like a disciplined investment process helps us navigate market volatility. So what we're always looking for is taking different opportunities at different times. For us, yes, we're looking at higher inflation and potentially higher interest rates at the moment, which are continuing to pressure the consumer. But what we always look for is how markets are unevenly maybe pricing in some of those pressures. We're not looking to predict what happens next, but where we think the valuation is maybe out of sync with other areas. We're always also looking to look through the noise, and we think our valuation focus is really kind of key to helping us navigate that. As I said, we can't predict the future, but what we can say is where the valuation sits and what kind of doesn't look quite right in terms of where the environment is. Patience pays off, as I've noted with the vintages. Sometimes it's really nice if it pays off very quickly, but quite often we might have to be patient, and we find having that time horizon arbitrage of taking a 3 to 5 year view really helps when the market is obviously quite often focused on the next 6 months or so. In terms of, our positions today, obviously we've got a number of positions in our portfolios, but kind of key positions that we are really liking at the moment are in emerging markets, healthcare, and the consumer cyclicals and defensive space. And then finally, obviously, we've got guys like Stuart to help support our clients along the way.
Thanks, Bianca. Yeah, sorry, did I steal your concluding line there?
No, all good.
Thanks, Bianca. If you skip to the next slide, we are just on sort of the hour, so that is the allocated time. We just in terms of any questions that we haven't got to today, we'll definitely come back to you outside of this call on those questions. So thanks for the engagement. On the next slide, just a reminder that we do have dedicated on the ground support from our sort of frontline team across Australia. If none of those sort of faces are familiar to you in your respective regions, please feel free to reach out with any questions or for a coffee. We love to engage, and we can also dig a bit deeper into what we offer across our investment set and as a partner in your business. And the last slide is one where we do have our Morningstar Investment Conference coming up in Sydney. It's an annual highlight on the calendar. While the in-person event is at capacity, there is a digital day on the 6th of May, which you are still very able to sign up for. It will include a Meet the Manager session featuring Bianca again. We keep her busy. Bryce Anderson, also who's heads up our SMAs and our real return funds with Bianca, and head of national sales for our managed portfolios, Vijay Srinivasan. So a lot to dial into beyond just that. We've got some great speakers lined up. If you can spare the time, but thank you for dialing in today. Please, if you could just complete the survey as we conclude the call. And we look forward to further engagement with you on the front line. Good luck out there. I think the best line I had from Bianca today was, we believe in vintages, whether they sort of translate in 1 year or 10 years. We're in this for the long game, and volatility, if anything, just gives us the opportunity to buy into those positions with more conviction as the market overreacts or underreacts. But thank you. We'll draw to a close now, and we'll see you out there.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.